Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora and welcome back to Markets, Mystics and Mayhem. This is episode 3. And we're going to talk a little bit about the Fed, the US Federal Reserve, a little bit about the Kiwi economy and how it's performed over the last wee while. And then we're going to get some insights from one of our financial markets dealers. We always get some really good insights from them right on the ground, how they're seeing things, how their business clients are seeing things. So that's going to be really interesting. But starting overseas and starting with the world's most influential central bank, the US Fed, they finally kicked off their cutting cycle. You know, they're joining the likes of the European Central Bank, the Bank of Canada, our own central bank as well. But Jared, why don't you take us through what the September cut looked like and how it all unfolded?
Yeah, absolutely. So the Fed kicked off. They delivered a 50. So I think most people thought they'd start with a 25, just like the Reserve Bank of New Zealand did and most other central banks. But no, they came out with a 50. So it was an assertive move. You know, I like it. I think it's good. There's obviously a need to get interest rates lower, so they're not mucking around, you know. Got to appreciate that. I think the decision was interesting in that the central bank is clearly happy that inflation's returning to 2% and it's going to stay there. So that's the key point in the background. And now they're wanting to remove the restrictiveness of monetary policy, which to me is the more important bit. Sure, they've delivered 50, but where are they going? And, you know, neutral in the US is somewhere between 2.5 and 3 or 3.5, depending on your argument. It's a long way from 5.5. So there's quite a few cuts to come, and it looks like they're doing it, you know, faster than others.
Yeah, it's interesting. But yeah, that 50 basis point move, they're obviously not mucking around with that. They've kicked off that cutting cycle. But talking about neutral, what is neutral? Why don't we just start there?
Yeah,
cash rate.
Good point. It's a theoretical number.
Yeah.
So we can't actually see it. We just know it's roughly around a certain level. And I think most places would think it's around 2.5 to 3 or thereabouts. And what it means is kind of like a Goldilocks rate. That interest rate is not too hot and it's not too cold. It's not stimulating. It's not restricting. It's just kind of at a level where you're not altering the inflation outlook, for example. So if we have it in our minds that it's somewhere around 2.5 to 3, we know that central banks are quite a fair way away from that, and there's some chunky moves to come.
So that all that easing, all the cuts we're expecting, that's just to get monetary policy out of restrictive territory. So it's not even adding stimulus just yet?
Yeah, I think that's a really good point, because a lot of what we hear from clients is this going to stimulate inflation? No, we're not anywhere near interest rates that are stimulatory. I think it's very clear that interest rates, you know, particularly New Zealand, are still quite restrictive, and, you know, they're at least 250 basis points away from neutral.
Yeah, and I guess the argument now that the Fed's gone 50 basis points, does that potentially open the door for us, for the Reserve Bank of New Zealand, to go 50 as well?
Yeah, why not? Why not? I mean, you're setting policy today with an 18-month lag on average. So yep. You're cutting today to have a full impact on the economy in, you know, the start of 2026, right? So you've got to have that in your mind when you're setting policy. And I think cutting more aggressively now for that to feed through faster is quite important, because our economy is struggling. You know, I put this to you, MJ. We've had some, you know, key data out in the last few weeks. What's happening with the Kiwi economy? I mean, do we need cuts?
Oh, definitely. We've been in recession for pretty much the last 2 years. We had the June quarter GDP report, which is basically just how the economy is doing over that June quarter, and it was another ugly read. Economic output contracted by 0.2%. It wasn't as bad as what we were expecting, but still it's a fall. And on a per capita basis, which is really talking about households' living standards, that declined for the 7th straight quarter. So actually, that total decline is around 4.6%, which is far deeper than the decline on a per capita terms than we saw during the GFC. So we're very much feeling this monetary policy restrictiveness. It's got this chokehold on economic growth, and rate relief is definitely needed.
So, I mean, I think it was last week's episode we talked a bit about migration, right? So we've had this surge in migration as you went through. These numbers would be so much uglier had we not seen, these extra 100, 150,000 migrants coming through.
Yeah, so that it's all this migration we've seen, which has slowed down, but the rapid growth in our population has sort of supported aggregate output. But now if we, slice up that pie for everyone, that slice is much smaller for everyone. It's shrinking, and it's been shrinking for the last 2 years. So, that is one factor.
And what industries are we seeing that are, is it across the board, or are we starting to see some changes within the industries?
It was a bit of a mixed read across industries. So you had industries like retail trade and wholesale trade, as well as hospitality, all posting, the biggest declines. But then that was slightly offset by, food manufacturing that was up over the quarter. So there are a bit of, there are some bright spots in there. So it was more of a mixed read across the industries. But, those interest rate sensitive sectors like retail trade, that they suffered quite a lot.
Yeah. So I guess if we're thinking about green shoots, are there any that are emerging already, or are we still sort of waiting for that to happen?
I think we're still waiting for that. And it really comes down to when these rate cuts start to actually feed through and hit the economy. It'll be industries like retail trade once the consumer is, a bit more stronger in terms of confidence, and that will translate into activity. So, retail trade, construction, that should get a lift as well once these rate cuts actually start to feed through. But it's just a waiting game, really. We're already hearing it on the ground that confidence has turned with the expectation of more rate cuts to come. But it's just a waiting game to see that translate into actual activity.
Yeah, and I think that's a global story too, just quietly. So, most central banks are cutting now. And I think the outlook for most of these economies is definitely better in the next year or so, because all these central banks are facing the same way and providing interest rate relief. So from a trading partner perspective, we kind of hope that trading partner growth this time next year is, much stronger, which helps the export side of the story as well.
Yeah, that's definitely true, because exports, again, another sector which have really struggled. They were the main, drag on growth as well. Exports on things like agri products, forestry in particular did, not so well over that quarter. So once, this time next year it should be a different story.
Yeah. So Fed did 50. RBNZ should definitely think about doing 50s as well to accelerate this move, because our economy, clearly needs it. I would like to get in someone to have a chat about what we're seeing from our clients. Who should we get in?
I think we should get Adrian Lodge, one of our FX dealers, and he's got some, I'm pretty sure, interesting stories to tell from what he's hearing from his clients. So we should get him. Yeah,
he's always got great insights. All right, it's great to have one of our senior dealers from financial markets, Adrian Lodge. Lodgy, over the years, it's been fantastic chatting to you about your interactions with our clients. Some of the insights that we get, ahead of the economic data. Let's just put it that way. But to help, the viewers, could you please tell us, what do you do on a daily basis? What does a dealer do for a major bank?
That's a very good question there, JK. Yeah, thank you for the introduction there. So in terms of what a dealer does, our role is to advise the importers and exporter clients around risk management, around currency. So we're talking to our say, for example, an importer client who may be buying equipment from overseas. They want to talk about what's happening in the Kiwi dollar against the US dollar, for example. What are their risks? How do they manage that risk? And that's what the conversation is from a dealer point of view, is advising them around that. What our view is on the currency, it's a view, but it's also understanding what the key risk and drivers are to manage that risk and hedge that currency for them. Giving advice, it might be obviously the US election's coming up right now. What does that mean for the US dollar? Obviously the big move last week on the US, obviously Fed cutting by 50 basis points. What do we see going forward? It's providing that data for them, technical and fundamental data, around giving them advice in terms of hedging.
Yeah. So, I mean, the importance of hedging, I don't think you can overstate it, right? No. I mean, if you're an exporter and you've signed a contract to send something over and you're going to receive US dollars, and, if that currency, pops and goes, miles away from where you wanted it to be, you could wipe out a whole... It
could be disastrous. Absolutely.
Yeah.
And that's the thing, I think you got to look at it from a business point of view. What is your main primary objective of your business? It's not to speculate on the currency.
No.
And so the idea is, get some basic hedging in place, talk to your dealer. I mean, there's no company that's ever too small to do it. And it's also like the big corporates that do it. We also talk to the smaller guys, or smaller companies, should I say, that, around understanding the risk and actually go, right, what sort of margin have you got in your product? If the currency drops from, say, currently today at 62 cents, what if it drops below 60? What does it mean for your business?
Yeah.
It impacts on your margins.
Yeah, exactly. And in your dealing with clients, like I said, some of the insights you get are just really, really cool. I remember during COVID, obviously COVID itself, but then, the shipping, the freight costs, the blowout there, you saw that, as it was happening. There was also some great insights around stock levels. One Christmas not getting the stock, and then the next Christmas having too much stock, and it's just fascinating stuff. So what are you hearing now?
So what I'm hearing now at the moment, obviously the shipping costs had dropped off quite considerably after COVID, but there has been a creep up in that global freight cost. And I think New Zealand's probably been impacted a bit more than what some of the other nations around the world, because like we're sort of right down the bottom of the southern hemisphere, almost not forgotten about, but the big global shipping lines are sort of focusing on the main key routes, and then obviously pulling some of those vessels and putting them to other key areas which are probably a bit more profitable. And I think there's a bit of a supply issue around that as well, which is driving up a bit of price and also congestion as well.
Yeah, no good. We're, like you say, we're at the end of supply chains, right? We get ignored, but it's so vital for our tiny economy to have clear shipping lines like that.
So what we're seeing is, like I was just talking to an exporter this morning, so at the moment, they're finding that they're getting whacked with additional surcharges from the shipping lines that they hadn't priced in, when they were doing their costings this year for their containers. This is an exporter up into Asia. They've been whacked anywhere between sort of 15 and 20% surcharge on their cost of already high price and freight. Yeah. But they're also finding that the containers, when they're hitting the Asia ports, for example Singapore, they can be delayed in transshipment between 3 to 5 weeks, which is adding quite a bit of considerable cost, because you've got to fund it as well.
3 to 5 weeks?
3 to 5 weeks. So, on average, it's, back a few months ago, it was only 1 to 2 weeks. It's now 3 to 5. And that's the note that they passed on this morning in terms of that.
Yeah.
5 weeks sitting on the port in Singapore, having to fund it while you're waiting for it to get to the end point is, it's quite considerable.
What else are you hearing?
What else am I hearing? In terms of I guess for our exporters are still doing quite well.
Yeah.
I think that's probably driven by probably a weaker Kiwi up until now recently. Yeah. So exporters are still doing around about 80% of what they were doing, a year or two ago. They're still pretty upbeat. Obviously China's a bit of a challenge, but the ones selling into the US or other parts of the market still seem to be going strong. We did quite a bit of hedging back in sort of late July when the Kiwi was below 60 cents. So we saw exporters come back in and add cover to the existing cover on the Kiwi US dollar. So exporters want the Kiwi dollar to be weaker, which they take advantage of. Vice versa, an importer wants the currency to be higher. So we've seen a lot of activity in the export market, and that's still going well. On the import side, it's not so faring so well. We're sort of finding that there is a bit of a soft demand in terms of the requirement to hedge, driven by a weaker Kiwi, and also demand obviously on the retail sales, for example, is all impacting that side of the requirement to hedge. So what we're seeing on the importer side, we saw a little bit of activity last week in that 62 and above as a Kiwi on the back of that Fed, obviously cutting by 50 basis points. We saw them come in and do a little bit of hedging, just a top up, but they're not hedging long dated forwards. They're just doing a short dated requirement, maybe between now and the end of the year, for example. So and then Kiwi Aussie crosses, we're looking at, we were at 92.5 last week. We saw some importers come into market, 2 weeks ago, come into the market and do a bit of hedging in that sort of 92.5 and above. But
Yeah.
And it's always interesting because your client base is very diverse. I know you've got some clients who do butter in airplanes, or
They
butter
do.
in airplanes,
Yes.
or e-bikes, or even I think someone told me that you have a client who imports US pinball machines or something like that. But just with that diversity of your client base, are you seeing any divergences in terms of performance? Where some of them doing better than others, or where really they're struggling?
I guess the clients that are really struggling are the ones that are importing, who are supplying into the retail space. So talk about the e-bikes, for example. We had a massive spike in the COVID times. Like, it was just unprecedented in terms of the volume of the currency they're buying, and how much they're doing in frequency, to where it's dropped right back. Bringing in boats out of the US, for example, we're doing quite a bit for one of our clients in terms of hedging there. That's dropped right off. There's no activity at the stage, but the ones that are bringing in, I guess, the essential sort of products, still going all right, strong. The manufacturing's still doing okay, but generally speaking, the import side is a lot softer than and outweighed by the export in terms of the exporting side.
Yeah. That just reflects what you were saying before, right? Weak domestic economy. If we're not buying stuff, we're not importing stuff. It's good to hear that some of our exporters are doing pretty well, though. That's probably one of the green shoots we're looking for.
And still, the forward order book is still looking quite good for a number of those clients. They're still pretty positive, pretty upbeat about it. They're not so worried about the currency. They're happy with the current levels. Sort of looking at when it was below 60, they took a lot of cover. But you also seen, even in the 60s, they're still low 60s. They're still
happy.
They're still happy. Absolutely.
That's interesting. So they're 2 cents in the money on their hedging. If they've done it below 60 and we're at 62 now, that's all right. I guess you're sitting pretty for a while.
And they're just topping up as they need to.
Yeah. Right. They're not taking views. They're just hitting the market when they need it.
Yep. And they'll just come through and they'll just do an extra 3 months top up or a 6 month top up. Just add an extra 10 or 15%, depends on the hedging policy, if they've got a hedging policy, but just taking the opportunity to keep rolling over that hedging cover as required.
Yeah. Nice. And that's how it's done for those thinking about exporting and importing and setting up businesses and dealing with complicated currencies. You talk to a guy like this, it's easy. Right, job done. That's it from us for another episode, another week done. Thank you for tuning in. If you want to contact us, you have some suggestions as to what we should cover, please email us at kiwieconomics@kiwibank.co.nz. Thank you, and we appreciate you following us.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.